Hi guys, have you ever thought of investing in mutual funds but scared due to complicated terminologies and concept explanations? Fret not, Skillioma has tried its best to define the entire mutual fund concept easily. So what is a mutual fund? A mutual fund is a collective investment managed by a professional expert who pools together the money of a large number of investors to purchase several securities like stocks, bonds, treasury bills, etc. You may be wondering, then what is the difference between a share and a mutual fund? Share is an investment in a single company from a single individual, whereas a mutual fund is a collective investment from a group of investors and is also a collection of shares, bonds, treasury bills. What are the advantages of investing in mutual funds? You can start investing with a minimal amount of 500 rupees. You can invest in multiple stocks and instruments. You can set up a systematic investment plan or SIP with any fund where your account is debited with a fixed amount every month. Your mutual funds will be managed by a professional expert who will charge some commission to do it, but you won't have to take tension of knowing which mutual funds are the best to invest and when to sell. Now, as we used the word securities before, what does it mean? Securities are the stocks or equities or bonds and other money market instruments that a mutual fund entails. There are two types, marketable securities and non-marketable securities. Marketable securities are liquid because they can quickly be sold in a share market and converted into cash. Examples of marketable securities are stocks, mutual funds, treasury bills, etc. Non-marketable securities. You cannot sell them immediately to convert them into cash. Examples are savings accounts, fixed deposits, etc. There are three popular types of mutual funds based on the investment strategy. Equity funds. These funds buy ownership in a company's business in the form of stocks with an expectation that the growth of the business will lead to an increase in stock price. However, a high risk of losing the invested or principal amount is also associated with this type of fund as stock prices decrease and increase frequently depending on the market conditions. Debt funds. These funds invest in securities such as government bonds, corporate bonds, or instruments such as gilt funds, liquid funds, which are also treasury bills, government securities that pay a fixed amount of returns. Debt funds tend to provide regular income with minimal risk. Balanced or hybrid funds. These funds invest in a combination of both equity funds as well as debt funds. They are riskier than the debt mutual funds. However, in comparison to equity funds, hybrid funds are less risky. Simply put, these funds take the best amalgamation of two types of mutual funds, either in the 65-35 or 70-30 ratio. For example, 65% of bonds and 35% of stocks. Hence, these investments are considered to be of moderate risk in nature. How to select mutual funds? You need to set goals to choose the type of mutual funds in which you can invest. For example, if you want to invest in mutual funds for short term between 1 or 3 years, then you can choose ultra short term funds like Aditya Birla Sun Life Savings Fund or short term funds like HDFC Short Term Debt Fund or even liquid funds like Axis Liquid Fund. For long-term investment, 8 or 10 years, you can choose equity funds like Axis Long-Term Equity Fund. Now that you know the basics of mutual funds, are you ready to know more? For learning more finance topics, sign up at Skillioma. www.skillioma.com. Skillioma, Beyond Curriculum.